Hey guys, this is Sandra, and I'm here to welcome you to Accounting 1110. This is Introduction to Accounting. I love this course, so we're going to get started. Now, we're looking at just the basic rules of accounting. I want to ask you this question. What is accounting? Well, it's the process of identifying, measuring, and communicating. Let's look at it. Economic information to our users, including our management of the company, our stockholders, our creditors, our financial analysts, and government agencies. We're going to break that all down during this course. Basically, it is the language of business. Think about it. We're of different nationalities. We're different kinds of people. Some of us may be Native American. Some of us may come from different countries. We all have languages, but business has a language, and that language is accounting. It's a form of communication. When we have a business, we have to be able to communicate to other people outside of that business. Guess how we do it, guys? We do it with accounting. Now, what is a business? Well, it's all of the activities necessary to provide the members of an economic system with goods and services. We could be a sole proprietorship, a partnership, an LLC, or an LLP. But in this class, we're talking about corporations. You know corporations, big business. That's what we're concerned about here. Businesses that have shareholders, people who want to know what's going on inside your walls. They may not be privy to our records, but guess what? They want to know what's going on, and we communicate with them with accounting. That's why we call it the language of business. Now, what is the nature of business activity? Well, it's what we do as far as our financing is concerned, as far as our investing is concerned, and our operating, our day-to-day activities. It's what we communicate to people. How do we talk to other people outside of our companies? We talk to them, guys, with our financial statements. When they come inside and they say, what's going on here? What are you guys doing? Whatever your business is doing, your corporation is doing, what are you doing? Are you eBay? What are you doing? Are you Amazon? Whatever you are, whoever you are, what are you doing? We all communicate in the same way, and we do it by giving them access to what we call our financial statements. You see, accountants use financial statements to communicate essential information to those who want to use or who need to make decisions, or those who want to know what's going on. And we have four basic financial statements. You need to know this. There's a balance sheet, there's an income statement, there's a statement of retained earnings, and there's a statement of cash flows. I'll say it one more time. There's a balance sheet, an income statement, a statement of retained earnings, and then there's a statement of cash flows. We communicate to those who need to make decisions on the inside, and we communicate to those who need to know our information through these four financial documents. And you'll be very familiar with those documents as we do those. But I need to show you the central formula, the central piece of information that makes the accounting world go round. And it's called the accounting equation. It is the foundation for the entire accounting system. And here it is, guys. Wait for it. It's magic. It makes everything work. It's assets equal liabilities plus owner's equity. I want you to think about the car, your dream car. Think about it being perfect. Think about all of the parts that you need. I love Hummers. I think they're beautiful cars. But even though I'm not savvy with cars, I know that a Hummer won't move if it doesn't have a motor. Well, in accounting, if you don't have the accounting equation, accounting doesn't work. Guys, you've got to remember this equation. Here it is, guys. Wait for it. Drum roll. Assets equal liabilities plus owner's equity. Let me say it again. Assets equal liabilities plus owner's equity. Let me explain to you what that is. Let's look at it. Assets, that's something that I have. Assets, liabilities, well, it sounds like something I owe. Owner's equity sounds like something I can keep. It makes me think about, I used to teach a lot of military people, and they would tell me about when they would first go off. My brother was Navy. And they would go off to different places, and they would be stationed in different places, and they would talk about when they were what they called E1s, and they didn't know what they were doing, and they get their first paycheck, and they would just blow it. But they would consider their paycheck an asset. So that would be on the left side of the equal mark. And then on the right side, they think about what they would do with that paycheck. They would be so immature with their money, they would usually owe it all out to somebody. So what they would owe out would be a liability. And the little bit they would have left over would be owner's equity. So I'll give you an example. My brother, for instance, would say he would just blow his money all over the place. So he'd get his paycheck and he'd already owe somebody because he borrowed money. So if his paycheck, let's make it real simple, is an asset and he had $100 in his paycheck, he already knew that he had a liability of $75 because he'd already borrowed money for some of the other guys. So out of his $100 paycheck, which was an asset, with his $100, $75 of it was a liability. What did he have left? $25. So $100 that he had was equal to $75 in liabilities plus $25 in owner's equity. So if we looked at the accounting equation, on the left side, that $100 that he held in his hand equaled the liability of $75 plus the $25 of owner's equity. I like to think of that equation, that accounting equation. When I was a little girl, I like to look at Little House on the Prairie. And my daughter, she likes it also, even though it was generations before her time. But my favorite part of it was when Laura and Nellie and all the little girls would play on the seesaw. The seesaw had to balance. And Laura would be so little that it would take someone on her side to equal the weight of one little girl on the other side. But the accounting equation is like that seesaw. It has to balance. So notice when I gave you the example of my brother's $100, on the left side, the assets equal $100. What was on the left side, the right side, the liabilities and the owner's equity had to add up to $100 also. So the $100 paycheck had to equal the $75 in liabilities plus the $25 in owner's equity. And as we move forward, you need to realize that the accounting equation, it must balance. And so when you go out to do your exercises, remember that your accounting equation must balance. Now, that gets us to that double entry system, something that you will learn as you go along also, to keep your equation in balance. Again, assets must equal liabilities plus owner's equity. And that's when the alarm will go off. If your sides don't balance, something is going wrong. When I talk about a double entry system in the accounting system, always remember that what's good for one side must be good for the other to keep your system in balance. It's like if you have siblings, what mama had to do for one sibling, she has to do for the other. Usually that's the rule. Well, the accounting system is just like that. Siblings that won't allow one to get something that the other one doesn't have. We have to keep the sides balanced. Now, later what we're going to learn is about debits and credits. And it's a funny little rule. I don't want you to think that a debit is a negative and a credit is a positive, because that's not necessarily the truth. Because you see, the left side of the equation is a bit fickle, while the right side kind of does what you think it would do. You can go ahead and start thinking like this. The left side is the fickle side that acts just the opposite of what you would think. It increases by being debited and it decreases by being credited. But the right side acts accordingly to common sense. A debit is a decrease and a credit is an increase. And you can put that in your pocket. We'll work on that a little later. But I just wanted to introduce you briefly to a double entry system that matches that balancing of our equation. Just remember that equation rules the accounting system. Just a brief introduction. Now, I also wanted to introduce to you our 4 statements. These are the ways, the statements that speak to us in accounting. I want you to think about being in a courtroom and someone getting on a witness stand and making up their mind that if I speak, if I testify, I will only testify 4 things. And these 4 things are going to be the balance sheet, the income statement, the statement of retained earnings, and the statement of cash flows. These are the only things that I will speak. In accounting, these are the 4 statements that speak for every company. We're talking about corporations, publicly traded companies. The balance sheet, when it speaks, it's sometimes called the statement of financial position. Think about someone who's taking a photo and they're standing still for that photo. That is the balance sheet. It is a statement that summarizes the assets, the liabilities, and the owner's equity of a company. It stands still. Now, the income statement summarizes the revenues and the expenses of a company for a period of time. The statement of retained earnings explains the changes in the retained earnings for the period, and it represents the accumulated earnings of a corporation less the amount paid in dividends to stockholders stockholders. Statement of cash flows will summarize the cash flow effect of a company's operating, investing, and financing activities for the period and shows where a company got cash during the year and how it uses that cash. And we will work through that in our homework for you to see what those four statements do. For now, I want you to understand that they each speak separately and distinctly, and they tell a different part of the story of a company. It walks in. If I were to tell you to investigate eBay, I would tell you, look at these four statements and tell me the story that is being told. And it will tell you if it's a balance sheet. Right now, at this moment, this is what eBay looks like. The income statement will tell you this is how much money eBay made in the year 2018. The statement of retained earnings will tell me how much money the owners of eBay made for this year. And the statement of cash flows answers the question, how much cash did eBay make for this period? And we will practice that in our exercises. Now, understand that all of these statements have a relationship. They go in order for a reason. You have an income statement, a balance sheet, a statement of retained earnings, and a cash flow statement. They're all related to each other. It's like a good family reunion. You may go to the family reunion, and the people present may have different last names, but they're all kin some kind of way. You see, the net income from the income statement flows to the statement of retained earnings. The ending retained earnings amount from the statement of retained earnings flows to the stockholders' equity section of the balance sheet, and the cash balance from the balance sheet is the cash amount at the bottom of the statement of cash flows. And again, we'll have an interesting exercise for you to see that. Here is an interesting example for you to see just a direct relationship here between net income and retained earnings that flows from the income statement to the balance sheet. So we wrap up everything that we just introduced you to. We said that accounting is just the language of business, and business is just that set of activities that serves serves our public. The accounting equation: assets equal liabilities plus owners equity. That is the revolving part of the entire system. Double entry system says that we have to have a reaction to an action, keeps that equation in balance. Financial statements, we listed them: the income statement, the statement of retained earnings, the balance sheet, and the statement of cash flows. And then we talked about a relationship among those statements. That's it. This is Sandra. Hope to see you next time. Get in there and let's get our work.